If you're considering investing in the Vanguard Russell 2000 ETF, it's important to understand what you're getting into. Among its larger components are well-known companies like Sprouts Farmers Market, Rocket Lab USA, Ryman Hospitality Properties, and Abercrombie & Fitch. However, when you take a closer look at the full list of Russell 2000 components, you might notice that many of the companies are relatively unfamiliar. This is actually one of the defining features of the ETF. It focuses on smaller, less established businesses. The Vanguard Russell 2000 ETF stands out for its low expense ratio of just 0.1%. This means that for every $1,000 you invest, you will pay just $1 in annual fees. Importantly, these fees aren't something you need to pay out of pocket. Instead, they're subtly reflected in the fund's performance over time. The current underperformance. Interest rates are a key factor. The Russell 2000 ETF has faced some challenges recently, underperforming major indexes like the S&P 500. The primary reason for this downturn is the rising interest rates. Over the past couple of months, economic data has led to a significant decrease in expectations for future Federal Reserve rate cuts. Small-cap stocks, such as those in the Russell 2000, tend to be more sensitive to changes in interest rates compared to large-cap stocks. Smaller companies are often more reliant on borrowing, and higher interest rates increase their borrowing costs. Historically, small-cap stocks have performed better than large caps when interest rates are falling, but during periods of higher rates, these stocks struggle more due to their vulnerability to lower consumer spending in tough economic climates. Hashtag why the Russell 2000 could rebound. Despite the current challenges, there are several reasons why the Russell 2000 ETF could bounce back. 1. Interest rate trends. While the Federal Reserve may slow the pace of interest rate cuts in the short term, the long-term outlook for rates is still downward, which is generally positive for small-cap stocks. 2. Pro-business policies. The incoming administration's anti-regulation stance could benefit smaller companies, which tend to be more nimble and able to adapt to changes in regulations. 3. Valuation advantage. Small-cap stocks are currently trading at their lowest price-to-book valuations compared to large caps since the late 1990s. The last time the valuation gap was this wide, small-cap stocks outperformed large caps for over a decade. Why the long-term outlook is still strong. While short-term volatility can't be ruled out, the long-term prospects for the Vanguard Russell 2000 ETF remain promising. Even though some analysts have lowered their expectations for a quick recovery in 2025, there are compelling reasons to believe that small-cap stocks will eventually see significant growth. In fact, small-cap stocks are now trading at some of their most attractive valuations in recent history, making this an opportune time for long-term investors to enter the market. The last time small caps were this undervalued, they went on to outperform the broader market for over a decade. While there's no guarantee the same will happen again, history suggests that buying at these lower valuations could yield strong returns in the long run. In conclusion, while the Vanguard Russell 2000 ETF may not deliver immediate gains, it offers an excellent entry point for long-term investors. The current market conditions, combined with the fund's focus on smaller, undervalued companies, make it a solid choice for those with a long-term perspective.